Welcome back to the latest edition of the InvestTalk market analysis for the week ending March 7th, 2025. Appreciate you all tuning in. I'm host Justin Klein, and today's video is titled Policy Uncertainty Drives More Volatility, but is a bounce imminent? Okay, so we'll take a look at some charts in a bit, but as usual, I'll give you an overview of kind of what the market did this week and what the economic news was telling us. Okay, so here is the heat map for the S&P 500 for the week prior, and what you can see here is a lot of red, especially in the Mag 7. Only Google and Apple really snuck out a bit of a gain. Actually, Microsoft was about flat, slightly up. Meta, though, down 5%. Amazon down 4.5%. Tesla down 6%. NVIDIA down 4.5%. And then take a look at the financial sector. You had a lot of losses across the board, especially for the riskier names. So names like JP Morgan down 7%, Bank of America 6%, Wells Fargo 7%, almost 8%, Morgan Stanley 8%. You had Goldman Sachs nearly 8%. You had what is this one? I believe this was Blackstone down over 8%. Same with American Express, KKR, another kind of private equity type of stock that would be around 12.6 for the week. So, this was still a very red red week overall. You had pockets of strength in consumer staples as usual. Only Philip Morris was at a loss, and that's been up a lot over the past couple of months. And Eli Lilly, another one of those GLP-1 trades that kind of continued to find weakness. Growthier name that was weak. But you had AbbVie and Thermo Fisher and Amgen. Really have some nice gains, and even some of the industrials. They eked out a gain as well. Transportation, Uber, Union Pacific, etc. So pretty interesting market for the week, but very much down overall, once again led by those mega caps. Now we'll dig into the charts in a second, but let's take a look at the economy for this week. U.S. construction spending year over year, that did tick down to only 2.7% year over year. And what you can see is, if you go back, Max, this typically does grow. And outside of the financial crisis, when everyone stopped building homes, and this 2019 period, where obviously tariffs were an issue, and then and that's one of the reasons why pre-COVID the economy was relatively slow. Remember, we had inverted yield curve and all of that, and so this is starting to hit pretty low levels where are there layoffs in the construction industry, and that could snowball on itself. So definitely weakness out of the construction space. Now, the ISM services PMI, that did tick higher. We know that the services side of the economy is the vast majority of the economy, despite what everyone thinks it is, which is physical goods. That's not true. Manufacturing is not really a driver of our current economy. It's really the services side. And so the fact that reaccelerated, that was a bit positive overall. You had prices paid index, though, that continues to accelerate to the upside. So if the Fed is thinking about cutting rates in the coming months, obviously that would fly in the face of a lot of the inflation data. That would be all because they're trying to protect on the downside due to current policy out of the White House, which is certainly bearish with tariffs as well as the Doge effect. How big of effect will they have? How many layoffs will really commence? We'll see. It hasn't been a dramatic amount quite yet. About 100,000 people have either been laid off, that was about 25,000, or 75,000 have taken the buyout. So combined, you're about 100,000, which in the grand scheme of things, we have about 100 million people in the workforce right now. You're talking about 0.1%. Okay, so it's not a dramatic amount. It's minor, and I'll show you in a little bit, but the unemployment rate ticked up 0.1% roughly. So that's kind of what you're seeing right now, is the market kind of reacting to a policy prescription out of the White House that is certainly bad for the economy, at least in the short term. It's not a argument whether it's good long term or anything like that. The fact is, it is bearish for the economy short term. Unemployment insurance that did tick up. Continuous claims, this is what I always watch. This is looking to break out. We'll see if we get a breakout next week. But certainly that continues to show, hey, these people, like 25,000 people, let go, and they're probably filing for unemployment. And that's a big part of this recent move higher. Non-farm payrolls for the month, that was on Friday. That was 151,000, a bit lower than expected. And so certainly some negative news on the labor front. So, and then here's the unemployment rate. As I talked about that, ticking up to 4.1. And if you round it, it's actually closer to 4.2. So, we'll see how that goes. But obviously, the labor market continues to weaken to some degree, but not in a major way. Average hourly earnings, though, if you have a job, that continues to accelerate, but that kind of feeds into the services side, right? That has bottomed and that continues to head higher. So that is more of an inflation figure than anything else. And when you look at the Fed policy, you have a Fed meeting coming up here in about 11 days. The high odds they will do nothing, but it's all about QT and it's all about the future path of cuts. And what the market is saying is there's roughly a 50% chance that they'll signal towards a cut in May. And if you go out to June, there's a very high likelihood they will cut by June. You're talking, that's pretty much priced into the market now. Over an 80% chance that they will cut by June at least once and potentially twice. A lot will depend on the market reaction, which we'll dig into in a little bit. I also want to cover this bank credit. So we a lot of people focus on what the Fed is doing and how much liquidity are they providing, and obviously stopping QT and cutting rates that will be dovish and help liquidity. But banks lending is the main source of new money creation in the economy. Okay, that's what we call broad money. There's base money. Okay, that's deposits at banks, for example. And then there's broad money. It's the money they lend out, right? And have that leverage 10 to 1 typically for a commercial bank. And so as long as they continue to have growth in lending, that is positive for the overall economy. And you typically want that growth to continue to accelerate. The issue here now, though, is since the fall, that growth has stagnated. Now, it's okay, it's at still over 3%, and that's positive, but it needs to kind of hold these levels and head higher and not roll over and drop below 3. If this drops below 3, that would be a signal that, hey, the macro environment that these banks are operating in is becoming so much more uncertain, probably mainly due to tariffs and Doge, and the fact that the White House is not speaking too much about stimulative policies like tax cuts. And so I'll be watching this to see if this does break lower. That would also be bearish for the broader economy, liquidity, etc. Now, this is actually bullish for the economy. This is the Treasury General Account. Okay, I've said this before. This is like the checking account of the Fed. And what you see is this is dropping dramatically. You think, oh, dropping, that's bad. No, it's actually a good thing. Why? Is because all this money is going into the economy. And so this is all about the debt ceiling fight. And the Treasury, to maybe avoid hitting that debt ceiling, they're not issuing as many treasuries, right, to refill this account. And they're using the Treasury General Account and winding it down. And that is money coming into the economy. Whereas when you issue treasuries, that's money flowing out of the economy, right? Going from out there in the economy into this Treasury General Account, which is not actively flowing into the economy, right? Anything that's in here is stuck in there, right? But then they spend it and it flows into the economy. So this is actually bullish. And so the fact this is being drawn down and the market's still declining, is a bit of a worry to me, right? Is that, hey, this should be pushing the market higher. Now, we could get a bounce here, and I think this is a good time to kind of pivot over to those charts. So let's talk about this. Okay, here is the S&P. Okay, and we hit the 200-day moving average. We attempt to breach it to the downside, and we failed. Right, we closed above it, closed above it on Thursday barely, and then closed above it nicely on Friday. Now we didn't close above Thursday's high. That would be a stronger indicator that we are going to get a reversal. You know, I said that here. See, last week was, so we ended last week right here, right? This bounce on Friday. So this is this green bar here. And what I said was, if we get above Thursday's high, that is an indication that this is the end of this pullback. But what you can see is we opened on Monday and we immediately sold off. Sold off again on Tuesday, bounce on Wednesday, sell off again on Thursday, bounce on Friday. And once again, you definitely have a situation where, hey, if we can get above Thursday's high and close there, that would be a strong indication that this 200-day moving average will support. Now, we had good volume last Friday. You can see that here on the S&P. And we had good volume this Friday, but not as good as last Friday, right? So it didn't hold. So what you're seeing here is a potential pattern, a potential bounce, but until you get confirmation of this, that's all it is. It's a potential setup and something to watch for, but not bank on. Okay. Now, I also want to go over here to the NASDAQ. The NASDAQ, similar type of vibes here. Let's zoom in. Similar pattern. Friday bounce, opened on Monday higher, sold off immediately. Bounce, sell off on Thursday, and now we got a bounce. Now, what is the high on the NASDAQ? That's even higher hurdle because that's all the way up here at, let's just about 18.4. Now we're at below 18.2. So we need over a 200-point rally in the NASDAQ and a close for this to be a viable bounce or viable support area, that, this short-term downtrend is over. Okay. Now we know with this White House, could be anything, right? Could be anything that spurs a bounce. Now we did it to 50% retrace from the yen carry trade unwind last summer in that bottom. And ultimately, this will be the real line in the sand, which, interesting enough, is what I drew earlier, which is you have this move lower, consolidation. And I said this before, if you don't get above the high of this breakdown candle on December 18th, go look at a video, one of these videos a few weeks ago. I said this exact thing. As long as we don't get above this, this is bearish. This is bearish consolidation. And what did we do? We eventually broke. And a measured move would actually get us, not surprisingly, right down to that 618 retrace. So if I'm giving a base case scenario, that's kind of my base case. Not only that, but you have a gap. See this gap here from the move on September 19th? Those gaps get filled. We're not quite there yet. Actually, this would be the gap fill area. Filling that would get down to that 618 retrace. So could you get a bounce here? Yes. Is it better than 50% chance? Based on the setup here, no, I wouldn't say it is. But obviously, it could happen, and we close above Thursday's highs on the NASDAQ and the S&P. And then I would say this pullback is done in the short term. Now, could this ultimately get a bounce and you find resistance kind of where we broke down, which on the NASDAQ here would be this area, right? That would be right there. Would not shock me to see a bounce into that and then another rollover and a lower low. And you get this kind of ABC pattern. And then you could even attack new highs, depending on, once again, policy. But if you break below this 17.4 on the NASDAQ, I think all bets are off. This uptrend is clearly broken. This momentum is clearly broken to the upside, right? If I zoom out to a weekly chart. And that's what's threatening here, right? Is this momentum to the upside, right? Even if you want to connect some lows, however you want to do it, right? We're clearly threatening that. And if, once again, you break the 17.4 level, this could easily head all the way back into the 13, 1400 level. And that's what I'll be watching for. Clearly, there is a lot of the major names, right? Look at NVIDIA. Look at this rollover. Look at this MACD has been negative for a while. But however you want to draw an uptrend line, right? That's broken in every way. Okay. So obviously these are leaders. Here's the SMH, same thing, right? Bearish consolidation, breakdown, should not shock anybody. And then you go to some of the other leaders. Meta had this huge rally, poor MACD, right? Negative MACD with this rise, and then threatening major reversal. Now holding, certainly holding right now, right? This 100-day moving average, and this is support. But once again, just because it's support doesn't mean it has to hold. It just means, hey, we're getting a bounce, and then you want confirmation that this is truly holding, not a bounce for a couple days and then chopping around and kind of staying in this area. If that's the case, that's just gaining power to break right through this support. So a lot of the major tech names are struggling. Google is probably the only one over the past couple of days, and Apple, that are showing a bit of strength. Okay, here's Apple. Those uptrends seem relatively intact. Amazon looks a lot like Meta right now at the 200-day moving average. Could hold it, pretty high volume on a Friday. But once again, if you watch for this pattern, just because it's hit support doesn't mean it's guaranteed to hold it over any length of time. Okay. Microsoft, obviously, that's showing a bit more strength. But Netflix, I think, is the one that is most bearish, right? That one kind of is reversing this entire move from those earnings back in January. And I think that has a lot more potential downside. Tesla as well. Tesla with a massive reversal here. Right? This is the Trump bump, and that's gone. I've heard some data like sales are down 50% in California. People in Europe are boycotting Tesla. So obviously, getting into politics in a polarized environment is troublesome for his brands. And so, we'll see if this holds. Certainly at support, but a lot of these are at crucial junctures. Okay, and obviously they drive the broader market flows. Let's pivot over to gold. Gold just continues to be strong, right? Just overbought here. And what you want to see in an overbought situation is just consolidation. Now, last week's move lower was a reversal. Okay, it was a reversal pattern potential. But with all reversals, you want kind of follow through. You want, we don't want it just to be a one-day flash in the pan. And what you see is of this entire move is pretty much any sell-off, especially hasn't broken this 20-week moving average, and just continues to power to the upside. And so the path to least resistance continues to be higher for gold. The miners had a good week as well. This is a signal that gold's not going anywhere, but probably up. Okay, nice week for the miners. Let's see, inflation expectations. Let's take a look at that. So that has pulled back. Okay, so that threatened to break out and it traits to break out, and that has pulled back some. And obviously, if the economy continues to weaken, that would be deflationary, and you probably see interest rates drop. So, interest rates for this week actually were up slightly. You see that sell off in the 10-year. But if the Fed has to get more dovish, and obviously a potential recession creates some sort of a deflationary impulse, you'll have long-term rates drop. Here's the growth to value trade. So this is rolled over as well. So, clearly growth is out of favor and still never recaptured this 2021 high. And so it doesn't shock me that this has that counter trend rally. I've said this, I expect this to be a counter trend rally. It's gone on longer than I expected, but the odds are good that we're headed for this type of 2022 environment where value drastically outperforms. I'm trying to think if there's anything else. Let's look at the move index and the VIX to close. So the move index, this has been heading higher, and this is now in an uptrend. Higher highs, higher lows. That's in an uptrend, and that's troublesome for the Treasury market. And so the more this continues to go up, definitely the more pressure there is on the Fed to ease more and to stop QT. And that would also ultimately be also weak for the bearish for the dollar. And this is another factor that will drive the growth to value trade. Is if you have the dollar dropping, that typically is bearish for growthier side of the market and bullish for value. Okay, why? Because a lot of the value stocks are harder assets, materials, energy, etc. And lastly, let's go to the VIX. So the VIX is in an uptrend, hit 23, not yen carry trade unwind levels, but December sell-off levels, and you got to bounce in the market. So could you see this pullback? Absolutely. But what you can see here is generally volatility is headed higher, and that it creates a choppier environment and more sell-offs. And so this is kind of right now, I think, in neutral territory, overbought, but in an uptrend. Okay, so probably base case, you probably get a bounce in markets soon, whether that's now or we get one more sell-off into that 618 on the S&P or the NASDAQ, and we bounce from there, and then make a lower high and then a lower low later in the year. That's kind of my base case because of this policy uncertainty and the fact that policy out of the White House continues to be bearish in the short term. But we know, Trump will pivot at some point to more bullish policy. Right? It'll pivot from Doge and tariffs to tax cuts and deregulation and maybe industrial policy. And those are bullish. And so it doesn't have to be a long, protracted, terrible market. It can just be a choppier market that ultimately you get at the end of the day, a 10, 15, 20% drop. But that's it. And then you continue higher. That's certainly possible. It's hard to say where it goes exactly in the medium term, but you have to call balls and strikes in the short term and kind of understand what to expect and what the likely outcome will be. And right now, the likely outcome is a choppier downtrend in the short term. So expect big rallies as well as more sell-offs. Well, that about does it. Appreciate you all tuning in, liking and subscribing to this channel. And reminding the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell security or to participate in investment strategy. Views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.